Is the economic expansion still on track? We're going to get the spoken word now from our Chief Equity Strategist, John Blank, who joins us via Skype from his remote office out on the West Coast. And I'm sure you're happy that you are nowhere near the Midwest or East Coast this weekend, John.
Terry, you read my mind. I am watching with sympathy, though, and I am a North Dakotan, so you guys are south from where I grew up.
Yeah, well, hopefully the bad weather doesn't get out your way. It's isolated to where it's at. Be that as it may, last week we had some fresh concern about the weak GDP reading that came in. So I'm going to pose that question back to you. Is this expansion still on track?
Terry, the answer is absolutely yes. And what I would like to go through is that already this week, in the interim, we have had revisions go back up to 1.5% for the fourth quarter of 2012 based on the stronger trade numbers that came out this week. So already we are putting to rest the idea that there was a type of slowdown in the fourth quarter from inventory and defense spending. That's already over. And really what matters is the look for the 4 quarters of 2013. And right now the forecast is for 2.25% annual growth, and that's basically going from about a 1.6 to 2 in the first quarter all the way up to almost a 3.2 by the fourth. So basically what we're looking at, Terry, is a ramping up of modest growth from very modest growth to slightly warm modest growth, but basically modest growth between 2.5% and 3% all year.
All right, so we're sitting here and we're recording this on February the 8th for those people who are trying to get a sense of the time references that we're making here. Now, you basically wrote that we may not see full GDP rebound until we put the rest of the cliff behind us. By that, are you referring to the whole sequester issue that still lies ahead?
That's correct, Terry. The thing we have right now is a March 1st deadline with the fiscal spending side of the cliff. And what's left to play out here is $85 billion in spending, which has been cut in half. One half of that is defense spending cuts. The other half of that is mandatory entitlement spending cuts. So the problem with it is we've really had a partisan gridlock decide where the cuts are not making it, or not economic cuts in the sense of efficiency demonstrating where the cuts should fall. So what's going to happen here is a negotiation and some uncertainty, and that's more or less likely to continue to keep some of the inventory numbers down and some of the defense spending numbers down for another quarter or so. And that's why I don't expect the really strong numbers to show up until the second half of this year, until we put a lot more of this to bed.
All right, bottom line it, what does all of this say to investors right now?
The bottom line for investors here is to pay more attention to the payroll numbers on a month-to-month basis than these GDP numbers. What you're seeing out of the revenue growth in the S&P 500 with the fourth quarter was about 3.5% annual growth in revenues. So, Terry, if you take a 2% inflation rate and throw it in there, you're basically getting a 1.5% to 2% GDP number out of revenues that are coming out of the S&P earnings reports, and that's 500 companies. So what investors should take away is that basically we're doing what we've been doing, and we're not getting any worse, and we're not getting any better, and that stable fundamental framework of modest growth is going to stay there for you all year.
Still keeps you on the optimistic side of the ledger?
Absolutely, Terry. I mean, my optimism, as we spoke, has nothing to do with GDP or revenues or earnings. It has to do with the ongoing removal of risk, global risk from this market, and I continue to believe that's going to happen, and that will continue to push us up into a much better fair value framework in historic terms.
All right, the spoken word on investing with our Chief Equity Strategist, John Blank. And with John, I'm Terry Ruffalo.